Michael, I got 8 ways to go here, and I'm going to go to one important idea in your note, which is this time is different in that we are far along in the tightening cycle. What does that mean for Jerome Powell?
I think the great danger here is that the Fed tightens too much for financial markets. I think we're in a very tricky spot. I think the sort of underlying economy, the labor market, obviously can withstand a fair amount more tightening, but financial markets here are wobbling, and it's the dual nature of this tightening. It's the combination of the withdrawal of liquidity and the increase of interest rates, which I think is starting to bother financial markets. My bet would be that at some point in the next few months, maybe even the next few weeks, we are heading for some kind of a financial accident, a break in financial markets
Now,
that really puts pressure on the Fed to do something different.
Michael, you and I are old enough where we remember the Little Red Book, which was Stanley Fischer out of the IMF in 1998, writing IMF essays from a time of crisis. Folks, everyone in the game had to read that book at the time. And this was Fisher looking at the effect of EM redounding on the developed world. When you see rupiah, rupee, any other number of currencies, Chilean peso unwind, what does that signal to you?
Well, no, it's not like 97, 98. We don't have FX pegs to deal with. I would say more than the EM currencies, but the really surprising thing is the weakness of other developed markets against the dollar. The sort of stunning weakness, as you said, of the yen, of the euro, of sterling, and this sort of ability of the dollar to just suck up all available liquidity. If we were going to have a 98 moment, I think Europe's more likely to be at the heart of it than East Asia this time.
Michael, when you say something will break, and we can get to that Europe point in a moment because it's an important one, but when you say we could have a financial accident, what do you think that looks like? Have you got anything in mind?
Well, I mean, it looks like very sharp downward moves in a number of assets. I think so far what we've done is sort of blow the froth off the equity market and take yields up and impose sort of very unpleasant losses on people. But by and large, people have lost what they've made in the last 12 to 18 months, which were themselves outsized gains. I think the danger that we have is I think credit's what we have to watch now. But if credit markets start to dislocate at the speed that rates markets or sort of PEs have come down in equity markets, well, then I think that 2022 has the ability to impose the sorts of losses on people that they emotionally cannot withstand.
And Michael, I guess that's what I'm trying to get to the point of. What's a dislocation? What's the difference between just the sell-off in the equity market, aggressive widening of credit spreads, and a dislocation? And who would be an accident for?
No, I think a dislocation is where you look at market prices and you really can't make sense of them. You can make a great deal of sense of the reduction in PEs that we've seen so far. You can argue they should be high, you can argue they should be lower. But, most of what we've seen so far has been, understandable when one looks at earnings or when one looks at inflation. A dislocation is when markets, as they did in 97 in October, in 98, August through October, in 87, it is a move in markets that really breaks its fundamental link. But you look at it and you're like, whoa, well, this is just liquidity being withdrawn.
Michael, this raises a question of when the Fed steps in, just to build on that point, especially if they still are trying to fight inflation that may not come down beyond 7.5%, if you believe Sanal Desai of Franklin Templeton. How do they come in and back away, even in the face of some of these dislocations that you expect?
Very tricky. I think they take whatever success they can to the bank. My guess is that, you may see a moderation of some of the commodity inflation over a period like that. And the Fed would use the excuse of looking forwards to do something different. I also think the Fed has different mandates that it balances. It talks about the employment mandate and the inflation mandate a lot, but we all do understand that there is an implicit mandate to keep the financial system functioning at a tolerable level. I think that there are price levels at which, or speeds of movement at which the Federal Reserve would be forced to do something. But also not the only central bank on the planet.
Well,
you've got the Bank of Japan, PBOC, and the ECB to consider.
To that point, I did want to follow up on what you said about the euro being the next real crisis, and that will be akin to some of the emerging market fissures that we saw in previous years. How far along in this are we, and what is the potential contagion there?
Very difficult to say. I think Europe was a mess going into this and continues to be a mess and has the additional strain now of, sanctions on Russia and, the potential for some rationing of energy, into the winter period. And that then does start to look a lot like the mid-1970s, where, it wasn't just inflation that you had to deal with, but an actual shortage of energy available for general industrial activity and consumer purposes. So, as I say, the Europe is a risk. It has poor political leadership. The ECB is not an entirely credible central bank. And, I would say the euro itself is a major currency, but for a lot of people, it's a voluntary currency. So, as I say, that if we had a region pulling everything else lower, I think that's the region you need to watch out for.
So, Michael, with that in mind, what are you buying right now?
We're still patient with energy. I still think that's a sector that has value. I think that, as panic builds, I think you'd want to be more aggressive. I think that precious metals, I think, still have potential here. But the honest truth is we're a lot less long today than we were 6 months ago. And, to have used recent strength to become less long than we were a month ago. So, as I say, this looks like one of those times that, whatever your mandate allows you to do, you'll take your exposure down to more, I would say, cautious levels than in a normal market environment.